It has been such a heated talent story. The banks are having trouble, so the hedge funds that are the biggest are hiring. What are you seeing in terms of the talent war as it persists today?
Well, I wouldn't necessarily say the biggest hedge funds are hiring. I want to bifurcate this idea of bigger is always better. Tiger Global a year ago was $100 billion. It's still $62 billion. And the main sort of Tiger Cub players, right? There's 4,000 long-short equity funds, but the biggest ones tend to be Tiger Cubs and related. These are funds that are tens of billions of dollars. They are having an atrocious second year, as Hema said. They're not hiring. I think the outlook for them looks pretty abysmal going into 2023. And yes, the growth is coming. Again, this isn't an outlier year for the multi-strats. It's just more of the same. They have built a great business model, which is managing volatility in all kinds of markets, producing uncorrelated returns, which are all alpha, and providing downside protection for clients, but also great upside. I don't know if you guys are aware of this, but if you look at because we're supposed to, as an industry, look at the cumulative return. If you look at the cumulative return of the biggest multi-managers, contrast that to the Tiger Cub universe or the more directional, more correlated long-short equity funds, over the last 3 years, these guys, the big multi-managers, have produced anywhere from up 30 to north of 75%, with Citadel leading the pack, and this year alone has produced north of 30. Versus if you're sitting at a directional brand name, Tiger Cub or related, the last 2 years are anywhere from together down 10 to down 70, with the majority of them being down 40%. Think of the hole these guys need to climb out of.
It's incredible setup for next year. But even some of the ones that were doing well this year, you saw a huge reversal. I think Bridgewater, for example. And I'm wondering what that means in terms of how long you have to perform to really build up that dry powder to hire the stars.
You bring up a great point. I want to talk about it as it relates to macro. Okay, you talked about Bridgewater. So we're talking about how well macro funds did this year. They did great, pretty much across the board. But you know what? A lot of these winners weren't so great last year. Rocos, which is up 45% this year, was down 26% last year. Brevin, which is up almost 20% this year, was barely up last year. And one thing that was in the article that you guys put out that Hema was referring to is where the flows have gone. Macro has actually had a huge amount, 26 billion of outflows this year, which might sort of seem weird given the performance, which is 5x the outflows last year. But investors are looking for consistency over time. And so I think these funds are kind of jumping on the bandwagon this year, these macro funds of, we've done great, let's be in the market raising capital, let's move to a multi-manager or pass-through type structure, which is like the holy grail of this industry. We'll see if they can, because investors are smart. They're not just, LPs are not just chasing performance off of 1 year. They want to see consistency over time. So it's going to take, I think, a few years, as it did for Brevin. They lost a tremendous amount of, they were 40 billion at peak back in 2013. They then had 4 years of pretty bad performance, fell to 6.3 billion, and it's taken them this long to kind of get back to where they are.
So as we're talking about performance on the street, when you perform well, you usually are rewarded quite handsomely, and it is the end of the year, so everyone is thinking about comp.
Yes.
In terms of expectations, broad strokes here for bonuses, for compensation, what are you looking at in the year ahead?
Yeah, it's going to be a really interesting year. Usually, let me set the stage like this. Usually, yes, it is a pay-for-performance industry, 1,000%. The two things that drive that are how the fund did and how you did as an individual. Usually, you can walk away if the fund did well, as a person feeling good about how you were paid. But the big thing that tends to be the issue in our industry is the idea of netting. Somebody did well, maybe the fund didn't do that well, and they end up getting docked in order to subsidize the rest of the fund. That's in like a normal year. This year, yes, if the fund did well and the person did well, they're fine. And if they sit at a multi-manager, they have a formulaic payout anyway, and there's a pass-through model, so there's no netting. But if you're one of these directional funds that had a horrific year, and you're the founder, how do you pay, horrific 2 years, how do you pay these people? Because you're looking at probably no performance fee. there's no line of sight to a performance fee. We're talking about we're talking about a drawdown that's basically down 40%. A management fee that's smaller because you've lost AUM by losing all of that capital, and probably redemptions are next to follow because LP patience is pretty threadbare at this point. So they're going to have a problem of how they pay people, and what we're hearing them do is give increased points to the people they want to hang on to. But the reality is you're probably not going to be able to get any yield from that for many years to come because there's not going to be a performance fee. Guarantee some portion of the management fee, some range, but you're not in it. As a rock star investment professional, you're not in this because the founder may give you something out of the management fee, right? So I think people are going to be pretty unhappy.
We only have like 30 seconds here left, but I want to talk about this idea of the crossover model, because private equity, there's a sense that the pain is still to come. We have not seen the brunt of the markdowns.
Right.
So is that model just over, or are they waiting to see another day?
It's not over because of the view that we get from the private side about dislocation coming to the public side, but the bar has definitely gone up. If you couldn't, as a founder, protect risk on the public side, and you also took a machine gun approach to getting into deals on the private side without any real sort of attention to what the appropriate valuation should be, I think it's going to be very hard to make the argument that you should do both. Not to mention, these teams are spread pretty thin. They're not really expert in either, and as one of my clients likes to say, dilettantes die.